Gold surges another 1.8% overnight. The Reserve Bank of New Zealand cuts its cash rate 50 basis points, which sends the Aussie dollar higher against the Kiwi. That's coming up in our 5 Things in 5 Minutes on Thursday, October the 9th. And then in our deep dive interview, ANZ New Zealand Chief Economist Sharon Zollner looks at what was behind the Reserve Bank's large cut.
I would characterise this perhaps more as a front-loading of the easing that they had already indicated they would do back in August, with a view to shoring up confidence, but with a very open mind about where to from here.
But first, in 5 and 5 with ANZ, gold continued its rally overnight, up another 1.8% to $4,079 an ounce by 4 a.m. Sydney Melbourne time. ANZ commodities strategist Sunny Kamari says it's up over 50% this year, the strongest annual surge since 1979.
This leg of the price rally was initially triggered by the resumption of the Federal Reserve's rate cuts last month after a long pause. But the ongoing US government shutdown has recently added fresh momentum to prices as deepening uncertainties enhance gold's heaven appeal. Investors have piled into gold-backed ETF, increasing to 146 tons in September, and this is the strongest monthly increase on record. In addition, tactical investors have also joined since September.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was up 0.5% and the Nasdaq was up 0.8%. The US 10-year Treasury yield fell 1.6 basis points to 4.115%. West Texas oil futures rose 1.5% to $62.65 US a barrel. The US dollar index rose 0.4%. The Aussie dollar fell 0.1% to 65.78 US cents, and the Kiwi was down 0.45% at 57.75 US cents after that big rate cut. Number 2, the Reserve Bank of New Zealand cut its official cash rate 50 basis points to 2.5% yesterday and signalled it was prepared to go further if needed. ANZ New Zealand Chief Economist Sharon Zollner says the move looks to be a front-loading of cuts the Reserve Bank was set to make over the next few months.
They did acknowledge downside risks, that the economy is weak and that although inflation is going to bounce in the near term, they're not worried about that because it's looking like it'll be much lower in the future, all those reassuring words. So some people have jumped on those and said, oh, look, there's going to be a lot more cuts. I've seen one report from offshore suggesting the OCR was going to 1.75. But if you look at it, I think you've got to think about what's different compared to August, and actually an awful lot was the same.
Number 3, the oversized cut sent the Kiwi dollar tumbling, with the Aussie rising up above the $1.14 mark yesterday. At 4 a.m. Sydney Melbourne time, the cross was at 113.9. ANZ FX strategist Felix Ryan says the Aussie is likely to dominate in the short term.
While we see that divergence in monetary policy, that probably will keep Aussie Kiwi well supported, that exchange rate, just that we have the RBA, of course, being a bit more cautious and around further rate cuts from here, while we have, of course, a softness in the Kiwi economy, really suggests that the RBNZ will continue on the easing cycle going forward from there.
Number 4. Turning to Japan, where data yesterday showed real wages, adjusted for inflation, fell for the 8th straight month from a year ago. Felix says that came as nominal wage growth was its slowest in 3 months.
That does add, I suppose, the margins to Bank of Japan caution over the policy rate, yet, of course, the developments around the election as well. And we did hear from Governor Ueda recently, really reiterating that the Bank of Japan are quite data-dependent and very cautious on the outlook. So that does, I suppose, support our view that we won't see any more interest rate increases from the Bank of Japan until January 2026.
Number 5, the Bank of Thailand unexpectedly held its key rate at 1.5% yesterday, against expectations for a cut. ANZ economist Crystal Tan says the pause came despite the central bank lowering its growth and inflation forecasts.
With price pressures absent, manufacturing subdued, and export challenges rising, we do think that the case for more rate cuts remains strong. And although the government has unveiled some fiscal measures in Q4 that will give activity a short-term lift, they won't necessarily change the underlying weakness in the economy. So overall, we think this pause will prove temporary. We think further easing is likely needed to support the recovery and also keep deflation risk at bay. So the Bank of Thailand next meets in December, where a rate cut remains on the table.
Crystal Tan there. Now, in our deep dive interview, my colleague Alex Tarrant talks to ANZ New Zealand Chief Economist Sharon Zollner about the Reserve Bank of New Zealand's rate cut yesterday.
I would characterise this perhaps more as a front-loading of the easing that they had already indicated they would do back in August, with a view to shoring up confidence, but with a very open mind about where to from here. In fact, they said we are open to further reductions in the OCR, so that stops well short of a promise. So I don't really think there's such a thing as a hawkish 50 basis point cut, but they almost got there. It was certainly balanced.
And so where do you see the general direction of the OCR going over the next few months and into next year? Has that really changed to what you were thinking in August?
Well, it would be very odd to finish an easing cycle with a 50-point cut, finish with a bang, go out with a bang. So I think the base case has to be a follow-up 25 basis point cut in November. So we've maintained that cut, which means that we now see the OCR troughing at 2.25% rather than 2.5%. But as regards the odds of more than that, well, if the data remains very disappointing, then absolutely we could see another 50-pointer in November. But it's also entirely possible that the data bounces more quickly than expected and they don't cut again at all. As regards February, I'll just point out that's nearly 5 months away. There's no question that by then we will be seeing a lot more evidence of the economy responding to the rate cuts that they've already delivered. That's just mathematically true. So even if the data is still a bit mixed and patchy, one would think that by then the temptation must be to wait and see how things go. Of course, by then we'll have a new governor to make it more complicated, but at the end of the day, she will only be one vote on a committee of 7 people.
An interesting comment from the MPC about inflation and how it might even be above the 1 to 3% target band at the moment. What do you read into that, and why would they mention that?
I think it was a good idea to get some commentary out there about the CPI because that data is coming out in just 12 days. And if they hadn't said something reassuring, like we know this is going to happen, everyone be chill, then you could have seen interest rates jump in response to that data. I mean, you still might if we get a big upside surprise. But essentially, if it does come out at 3% or whatnot, the market knows that the Reserve Bank knows that is coming and still chose to cut 50 basis points. Because after all, a big easing isn't worth much if expectations turn around and start going the other way very quickly. So it'll be the data that decides. CPI first, but then beyond that, I'd say it's going to be a question of the activity data and whether that suggests that we're going to crawl our way out of this hole or bounce.
So does this put a real emphasis on those sort of business surveys, the ANZBO, QSBO, given the backward-looking nature of GDP and how that sort of can't be relied on for a real-time indicator of economic momentum?
Yes, so our survey has been a lot more upbeat than the NZIER quarterly survey of business opinion, which came out the day before the meeting. That's mostly, I would assume, because their survey asks about how things will be 3 months from now, whereas our survey asks about a year from now. And obviously at the moment we're in a pretty dark place, but everyone knows that the Reserve Bank has eased monetary policy a lot and that takes a while. So you'd have to be a real pessimist to not think that things are going to look better a year from now. Whereas 3 months from now, the people thought things were going to be better at the start of the year, and Survive 225 just became Survive 25. So you can see why people might be a lot more sceptical about where things are going to look 3 months from now. So I would say that big divergence really reflects where we're at in the cycle rather than suggesting that one or the other survey is broken in some way. But absolutely, given the Reserve Bank sold this large cut as essentially in order to shore up confidence, those surveys do become even more important than normal.
Sharon Zollner there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, October the 9th. Catch you tomorrow with the latest US jobless claims data and what it could mean for the Fed. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.